Welcome back to 15 Minutes of Finance. I'm Brandon West, a CPA with 77 Financial Group, and I'm going to help you keep more of your money. Today's topic is the Small Business Tax Primer Part 2. And if you remember, about 2 weeks ago, we had the Small Business Tax Primer Part 1, where we talked about mostly the way that the structure of your business, whether it be a sole proprietorship, an LLC, an S corporation, the way that that impacts your business operations, and also the way it can impact future government assistance, wealth building, and techniques in the finance world, as well as certain write-offs and deductions, mostly saving on self-employment taxes that the structure of an S corporation can provide. So now we're going to go a little bit deeper into the specifics, not talking at the highest, not highest, that sounds like an order, but not at the broadest level of the structure of your business, but what you're actually writing off day to day, week to week as a business owner, and how to maximize your tax deductions as a business owner. Okay, so most of these are deductible regardless of the structure of your business and are not specifically tied to the way that you do business in terms of your entity structure. But we will talk about some differences with S corporations, LLCs, sole proprietorships, things like that, and the way that those structures can impact some of these things that we're going to talk about here. So I want to talk about first just kind of answering sort of what I see a lot of small business owners ask me, and I work with a lot of small business owners. That's sort of my niche at our firm, and so I have calls with a lot of new, potential prospective entrepreneurs that are referred to me by people I've worked with, that I've helped. I continue to work with a lot of small businesses that I work year to year with. Some of them we've gone through entity structure changes to help them on the taxes. Sometimes we've set up things like retirement plans. We've worked on quantifying home office deductions and business mileage, and how do we best maximize a vehicle deduction? Should they sell their current car? Should they buy a new car? Should they lease a car? How does depreciation work? All of those things. So I work with a lot of small business owners, and if business owners don't use a system such as QuickBooks or Xero or one of these sort of online accounting systems that help you organize your income and expenses into financial statements, usually there's a big confusion of like, what do you need from me at tax time? Okay, I'm going to need a profit and loss statement, your income and deductions for the year. Like, do you want bank statements? Like, how do I get you deductions, right? So a lot of these people start from square one, and that's awesome. That's literally why I do what I do. It is my favorite part of my job, is working with new entrepreneurs who don't know anything, and I can help them. I love getting people organized, and you can see when they start to understand their own business. It's such a rewarding process. So I work with a lot of people from the ground up, and it's like, what actually is deductible in general? Like, what does a business deduction mean, basically? And what am I deducting on my taxes? So the IRS's answer to that, and this is what I tell my clients, is anything that is ordinary and necessary for the course of your business. Okay, so that looks very different for different business owners, and that can be a little confusing because if you don't know anything, if you're very new to entrepreneurship, you're not sure what you can write off, and it kind of sucks that there's not a universal list of expenses. But someone who, someone who is writing news articles, okay, they're a paid contracted writer. They have probably a ton of like subscriptions that they're paying for. That's ordinary necessity for them. They probably have to subscribe to the New York Times, the Wall Street Journal, probably 10 to 15 of these magazines, small magazines. They probably have magazine, print subscriptions to magazines that are sent to them so they can see formatting and what length of articles are successful, right? That's your industry. That's ordinary and necessary for your business. I'm a CPA. I don't need a subscription to the Wall Street Journal to do my job, okay? Or, maybe you're something completely unrelated, like you're a private chef. A subscription to the Wall Street Journal probably does not help you, right? So that's not a legitimate business expense. You'd have to be able to justify, how does a subscription to the Wall Street Journal, how is that a business expense for the course of your specific business endeavor, ordinary and necessary for your business. So that's the general answer. Anything that is ordinary and necessary in the course of your business. Now, for those struggling to kind of quantify or categorize what those categories are, I'm going to go through what is the Schedule C on the tax return. So this would be if you're a sole proprietorship. Now, there's a lot of these same categories in LLC, partnership, S corporation tax returns. The specifically named line items are not necessarily the same, but a lot of these categories you're going to see entity to entity. But for the average kind of entrepreneur who's operating on a sole proprietorship, these are the direct categories that you're going to see quantified by name when you report that business income on your tax return. And then you can report any other expenses and label what those are. So I'm going to go through them real quick. It should give you a good idea of kind of what are the expenses of a small business that I should be looking at. It goes in order: advertising, car and truck expenses, and that gets a little bit more detailed. We'll talk about that. Commissions and fees, contract labor, depreciation and depletion, employee benefits, insurance, interest, legal and professional services, office expenses, pension and profit sharing plans, rent and lease expenses, repairs and maintenance, supplies, taxes and licenses, travel and meals, utilities, wages, and then other expenses, which you can list out on your tax return. So that's the categories that by name, if you have expenses in those categories, when your CPA prepares your tax return, they will be on that item. So it'll say travel, $1,327, whatever you spend for that tax year on travel expenses, okay? So those two things should help you understand what are business expenses. One, categorically, anything that is ordinary and necessary in the course of your business. And then two, those are a lot of the specific ones that are outlined on IRS forms that should help you kind of understand a lot of the main categories created by the tax code. There's lots of other ones. A couple examples of ones that I often report as other expenses that can be significant. Software and subscriptions. That's one that I often quantify. So you have Adobe subscription, you have a business email, you have Excel, you have, for the person who's a writer, they might have 13, 15 subscriptions to different magazines to do research. All of those sort of, maybe you have Canva for your graphics, all of those subscription services. That's usually one that we end up quantifying. Payment processing fees. That's one that I often see. So you make $120,000, but Stripe takes their 2.9% or Square or whoever you use. So you might have a couple grand in payment processing fees. That's one we often outline. So that's a couple examples of ones that you might not find specifically quantified that you would put in the details. But let's now go a little bit deeper, okay? So what are the more complex issues of business taxation? Those all seem relatively simple, right? So vehicles are a common, very, very common small business expense and one of the more complex ones. And there is an entire episode, I believe, I'd have to go back. I know for sure I've done home offices and for sure I've done the electric vehicle tax credits. I think I've done small business owners and how to write off vehicles. So go listen to that episode. You can search our episodes through vehicle or auto or depreciation. Look for that episode if you want to know, should I buy a car and how do I do that as a business owner? As a small reminder, you don't deduct the cost of a vehicle. And this is actually true of any physical thing. If you buy any one thing, equipment, furniture, whatever, if it's if it's over $2,500, you don't expense it and write it off the way you would these other expenses. You record it as an asset and then you depreciate it over time. For example, a vehicle, a car, has a 5-year life. A furniture and fixtures, equipment like that, has a 7-year life. Okay, so different types of equipment have different depreciable lifespans. And so you're taking a portion of the cost you paid as an expense over the course of the next several years. When you take depreciation on your home as a component of a home office expense, that is a 39-year life because that's considered, quote, commercial property because you're depreciating it as an office space for your business. Even though it is your home, a home office is now, that's looked at as commercial business property. So it's a 39-year life. Okay, so there's all sorts of different lives for different assets, and that's one of the things that a CPA hopefully knows and can help you with. So you don't deduct the cost of a car. You record it as an asset, and then you deduct depreciation. And there are special bonus depreciation rules that allow you to take more of it in the first year. So for example, for cars under 6,000 pounds, you can deduct $20,800 in the first year. So let's say you buy a $40,000 car, it's under 6,000 pounds. It goes up to, I want to say it's around $28,000 to $30,000 for that next step up of 6,000 to 14,000 pounds. Okay, so, but you bought a car under 6,000 pounds. It's a business car, fully used for business. You qualify for all of the different checks and balances that you have to check. You record that asset, that $40,000 car you bought. You take $20,800 in the first year, and now you have $19,200 that's going to be taken over the remaining 4 years because it's a 5-year asset. Okay, and that's how you buy a huge piece of machinery. You buy a massive sign for your building. Again, that's a different lifespan, but it's an asset that becomes depreciated. And there are some asset types. And there are different types of bonus depreciation. And I've talked about it. I won't make this a depreciation episode, but there are different amounts for different asset classes in terms of how much can you take in that first year. During the Tax Cuts and Jobs Act, those first couple years, they upped bonus depreciation to 100% without a cap. So people were buying, huge firms were buying millions of dollars of equipment, massive, CNC machines for industrial manufacturing that are $250,000 each. And instead of creating an asset and depreciating it, it was depreciated all in the first year rather than over 7 years. That's a $250,000 deduction. That's very, very significant, okay? Especially given the fact that you don't have to necessarily buy these things with cash to depreciate them. So in this example, maybe you bought that $40,000 car on a loan. You didn't actually expend any money to buy the car. Maybe you bought it in, August. You made 4 payments equaling $2,500 total. But now you get a $20,800 deduction. So you can see how you can play around with these things a little bit, and you should strategize with your CPA. There are categories here where you can create deductions that were not cash outlaid, let's say, to create those deductions. So it's not money you had to spend, but it's a deduction to offset your income and reduce your taxes. Okay, so it'll all balance out in the end, but you can accelerate some of these things, which can be relevant depending on how much money did you make, what tax bracket are you in this year, will you be in a lower tax bracket next year? There's things like that. Okay, so that's enough about vehicles. Hopefully that gives you guys an idea of kind of how significant that can be. It can be tens of thousands of dollars, and there's complexities to it. Another thing that's underutilized or a lot of people don't really understand is the self-employed health insurance deduction. So as someone who is self-employed, you can deduct the cost of your insurance premiums, okay? Now, you don't directly deduct it on your business form. You don't do the Schedule C deduction. You report it as an adjustment to income. So it does reduce your income. It is a deduction. It just doesn't go on the business expenses sheet of the tax return, okay? But it's a very significant thing. Insurance is very high these days. So some people can pay $10,000 or more, especially if they have a family, a spouse, a couple kids, and you're paying premiums for a 4, 5, 6 member family. It could be tens of thousands of dollars in a year. So that can be a very, very significant deduction. Make sure if you're an entrepreneur and you're working with a CPA, hopefully they're asking these questions. But if not, make sure you tell them, hey, I pay for health insurance. Can we deduct that? And maybe there's some complexity. It depends on your business structure, but probably that's deductible for you and can be very significant. Number 3, the home office deduction. Okay, so if you have a room in your home, the IRS uses the terms regularly and exclusively used for business. Okay, so that means it can't be a guest room with a desk in the corner. It has to be a room that's separate that you use for work. Now, is this something that people probably fudge on their taxes? I'm sure I've had clients tell me something's a home office and there's no way for me to know, and there's probably no way for the IRS to know that over the course of a couple weeks their in-laws were staying with them, right? And it's not actually exclusively used for business. So don't lie about it. If you're audited and you can't show a separate room, all you have are 2 bedrooms that are actively being used, you're going to be in trouble. But understand that the IRS calls any room used regularly and exclusively for business is a home office. So that allows you to do several things. If you're renting, you can deduct the portion of rent, utilities, renters insurance, internet, things like that are used in the business but are also used by the rest of the home. Let's say your home is 1,000 square feet. The office is 10 by 20. It is 200 square feet. That's 1/5 of your home. 200 divided by 1,000 total. So now 1/5 of your rent, utilities, internet, those expenses are deductible as a home office. If you're a home owner, you can deduct depreciation on your home based on that percentage of the home office and based on that 39-year life. You can deduct mortgage interest, property taxes, homeowners insurance, utilities, hazard insurance that you might have. You might have HOA fees. You might have maintenance on the roof. The proportion of those expenses based on that square footage breakdown are legitimate home office expenses. So those can also be very significant if you qualify for a home office. Okay. Fourth one, and it's the last one I'm going to talk about in particular in this episode, and that is contributions to retirement accounts. And this is something that works slightly differently, and that'll segue into the last overall thing that I want to talk about. So if you set up something like a 401k plan, if you are the only employee or you don't have employees, you're just a sole proprietor, there's no employees, you qualify for a solo 401k plan. All that means is it's a 401k plan, but you're exempted from a lot of requirements, such as making sure it's not discriminatory towards the top earners. There are certain rules and restrictions of 401k plans. You get exempted from a lot of those, including a lot of the filing requirements that usually add time and complexity to a 401k plan by being a solo plan that's exempted from a lot of those requirements. We've stressed this a lot. We're in the process of setting up our 4th small business retirement plan in the last 3 months here. There is not a better way to save for retirement than as a small business owner with any sort of retirement plan, but specifically if you are a entrepreneur without employees that has the benefit and the gift of being able to qualify for a solo 401k plan. It is so advantageous to you. Let's go real quick over how powerful this is. You can contribute of your own deferral from your, quote, your wages as the employee portion, the maximum $23,500 every single year. The most you can do to an IRA is $7,000. Huge difference. 2, you're allowed to put that money in as Roth contributions, okay? So you can put Roth contributions, you don't get a tax deduction for it, but now all of that money grows tax-free, and in retirement, you can pull it out tax-free. So $10,000 that you put in as a 27-year-old entrepreneur, when you're 60, 33 years later, and that's hundreds of thousands of dollars, that's all tax-free now. Massively powerful. The most you can contribute to a Roth IRA, again, $7,000. And once you earn a certain amount of money, you no longer are able to contribute to a Roth IRA. You are not exempted from Roth 401k contributions by income limits. You don't get capped. You can be making $800,000 and you can still make Roth contributions to a solo 401k plan, okay? Massively higher contribution limits, Roth eligibility for tax-free wealth in retirement, and here's a really big one, you can manage your money or work with an advisor. So one big disadvantage of a 401k plan is that you do lose flexibility. So we design 401k plans. So we know this. James sits down, he chooses a list of funds. His goal as kind of the fiduciary responsible party of this plan, we have to pick funds that represent kind of the preferences and the available offerings that the owner of the company wants their employees to have. We have to make sure that it's a range of offerings that allow people to invest in different risk levels or different timelines. And there has to be different options. It can't all just be equity options for people who are maybe in their 60s and they're going to retire soon, who don't want volatility. We have to have the availability of things like target date funds or funds that have a large proportion of bonds in their makeup that don't fluctuate with the market. Okay, so there's lots of choices that go into that. But at the end of the day, you have anywhere between probably 10 to 20 options at the most. In a solo 401k plan, you don't present fund options. Part of that exemption from a lot of those requirements is rather than having fund options and it being administered the way that a traditional 401k plan is, you just get to transfer that money to your solo 401k plan and manage it the way you would a brokerage account. So you can be in individual securities, you can be in growth ETFs, you can balance your portfolio by having a makeup of different investment options. You have flexibility as if it was an IRA or a brokerage account, but within all of those benefits we just talked about a 401k plan. So it is such a massively powerful tool for small business owners, and it is one of the single most advantageous things that small business owners have in general is access to high contribution limit, high flexibility Roth retirement accounts as a sole proprietor or self-employed individual, regardless of the business structure. Okay. And it often is a lot more than $23,500. Okay, so that's just the employee portion. The other limit is the amount that the employer quote can put in, even though it's one and the same. You're self-employed, is equal to 25% of wages. So for an S corp owner, the business can match up to 25% of what you pay yourself in wages. For a self-employed sole proprietor, you're limited to 25% of that net income on Schedule C. So you could make $150,000. You can defer 23.5 as your quote employee portion, and then another just over $25,000 on the employer side, contributing almost $50,000 in a single year in a Roth account that grows tax-free and is able to be actively and aggressively potentially managed for long-term growth. That could be just 1 year of that can be millions of dollars in retirement, depending on how young you are. And then if you can obviously maintain that and even continue to contribute $5,000 or $10,000 a year for the next 20 years, you'll be a multi-millionaire with tax-free income in retirement that will dwarf the retirement opportunities of all but your absolutely most rich friends. And that's what's available to you as an entrepreneur. So the last thing that I want to talk about here is that, because we've talked about the structure, and I do want to stress, again, go listen to the Tax Primer Part 1, the choice of how you structure your business, most importantly and most commonly thought about, is the choice of whether or not you should be taxed as an S corporation. That choice is massively important. And a lot of people have a sort of misconception of how that works. They've worked as an entrepreneur. They're used to Schedule C. They go, I write off my car. I write off my home office. I don't want to lose write-offs by being an S corporation. That's a misconception around that S corporation election choice. And I want to clear this up. You lose almost nothing as an S corporation owner. So what it does is it just takes a new form. What you would do as an S corporation owner is you would do something called an employee accountable reimbursement plan. So you would quantify all of these costs. I have a home office. I drive business miles for my job. You quantify these things. The business reimburses you for those expenses as employee reimbursements. They're accountable because you have to quantify them. You can't just pay yourself like a per diem. There's different rules that are not as advantageous if you're paying yourself a per diem as an employee. So you want to quantify these expenses, then the business reimburses you. The business is now able to deduct those as if the business paid for them. So home office is now rent to the business. Mileage that you drove for work is now vehicle expenses and mileage driven for the business. Okay, so the business is now getting these deductions, and you personally don't claim that income, that reimbursement, as income, because it's not income earned. It's a reimbursement of qualified business expenses that you paid for and are now getting reimbursed. So it's a win-win situation. You're still able to get those deductions. So don't think that you shouldn't make that S Corp jump because you'll lose write-offs. That's not the case. Same thing with the retirement plan portion that we talked about. You don't lose the ability to develop a solo 401k plan just because you're an S corporation. You just now have to base your contributions as your employee deferrals, reduce the W-2 that you pay yourself, and then the employer matches have to be capped to a maximum of 25% of your salary. So if you pay yourself an $80,000 salary, you can put $23,500 of your own money deferred into a 401k plan. Now your taxable income on your W-2 is going to be, $56,500 rather than $80,000. That's a huge deduction. Then the business can match up to 25% of your salary. That's $20,000. Now the business can match $20,000, and you've put $43,500 in 1 year into a 401k plan. So just about all of these options are still available to you if you are an S Corp owner and employee, and you go that route with your structure. Don't think that you lose write-offs. There's just an extra step of how you have to quantify them. And the way it looks is a little bit different, but the business gets those same expenses and you're still able to reduce business income by the amount of those tax deductions. Thanks for listening now to both parts of the Small Business Tax Primer. I hope it's helpful. I know it's helpful. Sorry, not to be, I don't say that in a cocky way, but these are things that every single day, particularly now in tax time, I'm working with small businesses and small business owners on. I just work with someone who works in real estate. It's their first year working as a contracted agent rather than just an employee. Their tax bill was roughly $10,000. By the time we got through subscriptions and things like that she realized she could write off, the business portion of her phone and internet and utility bills like that, a home office that she did legitimately have in her home, a business vehicle she bought for all the miles. We went from $10,000 in taxes owed to less than $1,000 in taxes owed. So these things, proactive tax planning with a CPA, can save you a lot of money. I see this every single day. So these are ways that you get to keep more money in your pocket. And I would even argue, probably more importantly, when it comes to the retirement plan portion of these topics, ways that you can build wealth at an astronomically higher rate than someone working a W-2 job. There's so many more options and so much more flexibility allowed by entrepreneurs to save the money they earn and to invest and grow that money into future wealth. It's very, very powerful. So props to all the entrepreneurs out there. We're here for you. We'll continue to give you tax topics. Please subscribe, share this with other entrepreneurs. These 2 episodes, Tax Primer, part 1 and 2, very important. It's a combined probably between 40 and 50 minutes of listen, and it will, especially for someone starting out who doesn't know the first steps to take, it will save them money. Seriously, it will. So share this to anybody who it would be, relevant for. I'll end on one thing. It's only somewhat related, but as a new dad myself, I just saw this on social media that the average working father during the week spends 62 minutes a day with their kids. Okay. So if that's not a reason to be an entrepreneur and to learn about if this kind of choice field, whatever you want to call it, is right for you, I don't know what is. That was very sobering to me. It made me very appreciative. I have breakfast with my family almost every night. I'm home for bedtime almost every night. I work from home half my days that I'm working and doing taxes. Entrepreneurship is so rewarding. It's important to make sure that you don't jump into it not know any of this stuff, don't talk to a CPA, and then you're paying way too much in taxes, income tax, and remember self-employment tax because you didn't structure as an S Corp or you didn't know what you could write off. It could be tens of thousands of dollars that you're overpaying in taxes. So it can be a really bad situation if you're not informed, but both in terms of lifestyle and monetary savings. It's such a powerful thing being an entrepreneur. There's so many things available to you to maximize your monetary situation. I hope you're learning how to maximize your situation as an entrepreneur. And if there's anything else that you want to know answers to as an entrepreneur, leave a question. I know on Spotify, you directly have the ability to leave comments on videos. Let me know what you want to hear next time. Anything you want to know as an entrepreneur, I'll answer for you and I'll help you save as much money as possible. Thanks for listening to another episode. Feel free to share it with anybody you know. And as always, invest early, invest often. We'll see you next time.